Let's talk about this
Yes.
wacky housing market that just is the strangest thing ever. So, like, let's jump into interest rates, mortgage rates, and try to make sense of this whole thing. So, where do we start?
Sure, man. The mortgage rates, it's like they're doing their, I was going to make like a Lindsay Lohan joke, but I know that she's doing great now. And so I didn't want to go back there. I don't want to bring anybody down when they're out there winning. But no, they have totally kind of jumped off tracks on what normally guides interest rates. And that's kind of been the theme of this year, and it always goes back to when I talk to people that are down in the market and like thinking the world's gonna end, is I'm like, this is what we always talk about, where the one thing that's the same in all of these cycles is that they all seem like they're never going to get any better and we're never going to get out of it. And it's like world, the depression or the end of times for mortgages. But when in reality, that's the one thing that's always the same. And so what's been driving us, we've gotten a lot of inflation data back. So we're starting to see jobs numbers that we've talked about before are starting to come down, or that labor market's softening, right? So we got jobs numbers last week that they were looking for 203,000 jobs. And if you guys see me look away, it's because I got some data over here, so I'm
Do
not
it.
making things up.
I always look at
But we
my
saw
data. I always got my phone. It's like, all right, what am I
jobs
talking
numbers
about?
looking for they're looking for 203,000 jobs that came back at 187,000, and they revised 49,000 less jobs from the previous 2 months readings. And so we're not out there looking for people to lose jobs, but that's one of the, like we talked about last week or 2 weeks ago, is that the Fed is looking for this labor market to soften. And the reason for that is, the reason that ties into inflation in mortgage rates is because when there's a much smaller labor force, there's not enough labor force to fill the vacancies in jobs that are needed. These companies have to pay people more. So you saw this, like you saw a lot of this was like a big thing when they were talking about raising minimum wage to $20 an hour and doing all these different things, is that all trickles down to the consumer. And we see that show up in things like the consumer price index and the personal consumption expenditures that you look at and the government gauges inflation on. It's how much money we're spending. So softening the labor market and showing that job creations are coming down is showing that companies are starting to pull back on that. Another really interesting indicator that came out of that also was decreasing hours worked. Came down 0.1%, and then also average weekly earnings. Those were up 0.1%, which missed a little bit of estimates as well. So, one of a big cost saving measure for companies when they're going into like saving mode instead of spending mode, which is what the Fed is trying to do, is they start to decrease hours worked for employees.
Sure.
Um, Another big part of that jobs number we saw was a substantial amount of part-time jobs that were created there. And another big chunk of that on top of the part-time jobs were jobs for people 55 and over. So again, nothing wrong with either of those things, but that isn't like, when people think of the job market or the labor market really rocking and rolling, these aren't people making $120,000 a year or even $80,000 a year. In a lot of cases, not even 70,000, which doesn't get you that far right now. So jobs information coming in a little bit softer. And then we saw consumer price index this week, which came in a little bit below expectations. We can dig into that more later. So everybody, you think this is all great news. Like, this is what we've been needing, and
Right.
interest rates are liking these things. And then you have the big ugly head of the government that comes back and issuing substantial amounts of treasuries and long-term debt, which finances the government spending bills that were passed. So we saw a lot of issuance of new bonds, which have to be absorbed in the market. And on top of that, you have a bunch of banks who now have new liquidity requirements that the government has now instituted on banks, because we saw some of these regional banks failing. There are some concerns with banks to say, hey, you guys got to keep more cash on hand in case people start coming to you. So again, they're selling a bunch of these long-term mortgage bonds, treasury bonds at a loss that are flooding the market. So what happens when you have way more in the market than there are buyers? You have to make those things more valuable to them. So you're starting to see you'll see those things, the yields on those come up, and in turn, you and I, Main Street, end up paying for that. So when you don't get tax increase, if you think about it, just going way deeper on it, like when you see government spending go up and people are like, oh, our kids are going to pay for this and we're going to pay for this, like this is how we pay for these things without increasing tax rates, right? Like is when we
Yeah.
borrow money, it costs us significantly more because we're financing what the government is borrowing at the same time.
So there's a lot going on, and so as a result of that, because the other thing too is we took a week off of the show. I think we were both on vacation, and so the Fed met too since the last time we've done an episode on the housing market. And so just speak to that for a second, and then after you get through that, I want to talk about based on all of that, what is that resulting in how mortgage rates have responded?
So the Fed met, they raised their rates 0.25%, which was baked into the market. The press conference afterwards, it was literally it was very, very, it wasn't, there were no fireworks, right? It was exactly what they had expected. The Fed said, hey, we're going to continue to make data-driven decisions on rates at this point in time, which is looking at the CPI and the PPI and all these inflation numbers in the labor market. So they're watching all of these things. And that was, again, widely expected. That's what we thought they were going to say. That's what they're going to continue to do. And that's almost worse than them saying we're either going to raise rates or we're going to pause or we're going to decrease rates or loosen some of our policy. And the reason that it's worse is because now markets tend to trade on speculation and emotion rather than saying like the Fed knows it's going to raise rates again, and so we're going to see rates go up in another 6 weeks or whatever it is. They're going to raise them 0.25%. Where now, when they say we don't know what we're going to do, every single morsel of information that comes out is something that is either really positive or really negative for the market. The bond market sells off. There are just all kinds of reactions to it. Because it's almost listless,
Yeah. Well, and the thing is that's interesting is yet again for Q3, the mortgage rate projections just came out from Fannie Mae, MBA, and NAR. And this is what I think everyone in the industry is looking forward to. But Fannie Mae projects that Q3, they come down to 6.8%. And Q4, they come down to 6.6%. MBA saying 5.9% by the end of 2023. And then NAR saying by the end of the year, 6.3%. So average about 6.25% by the end of the year. And so that's what that's where the mortgage rate forecast is coming in for the rest of the year. How do you see it? And because if that's true, then I think that we get right back into a good spot for the housing market, quite frankly, which sets us up to have a really, really good 2024. But how do you see it for the rest of the year?
I feel like,
hold on, before you do that, I'm sorry. Where are we at now? So as a result of all of that, just give us high level. What are rates doing right now?
7.25 right now.
So stubborn.
Yeah, you're probably talking 7.25 with maybe a point today on a loan. You probably, I'm doing loans around. You try to get there's like mental hurdles, that when you get that 7 in front of that number, it's like, whoa, so we're doing a lot of the 6.99 and we're getting creative with cost structure, whether it be, like trying to work some concessions after the inspection type of thing is the way a lot of people are going. I'm seeing a lot of gifts that are actually buying a little bit of cost for people or building that in. But realistically, like 7.25, without using some of the incentives we get, like sharpening the old pencil type of thing, you'd really be at probably like 7.6, 7.7% today.
Wow. Okay. So what do you think about those projections I just talked about for the rest of the year? Do you think those are aggressive? Do you think those are, is that in line with what you believe, or how do you see it going?
I think those are a little optimistic. As much as I'd love to see rates in that environment, I think that we're probably going to stay in the high sixes. Like that 6.8 number is pretty fair. 6.9. That being said, I was just I do a weekly like market update email, and I was just typing that out. And 2 weeks ago I locked a 30-year loan at 6.375.
Hmm.
That had a point with it, and yesterday I locked a loan. It was a smaller loan, but still it was at 7.375 with a half a point. So that's a 1 point swing, and it was a little bit different transactions. It's kind of extremes, but so I don't think that 6.25 is impossible. It just depends on what's driving that.
Yeah.
And
So you
I,
said the difference between those two things was 1 week. Is that what you said, or 1 month?
2 weeks.
2 weeks. 2 weeks. Yeah, I
So
mean, that's why it's
4%.
changing so fast. It's just crazy how rates are moving so quickly. I mean, you and I have been in the business almost coming up on 20 years now. It's like we've never seen rates move the way that they have moved, this year. It's crazy.
Yeah, I mean, we probably lost a half a point since Wednesday, and that's just with a 30-year bond auction that went sideways yesterday. It was met with below average demand, and that was just enough to tip everybody into the bond market having a sell off. And then today we received PPI, which is a producer price index that came in. It's a measure. It's a leading indicator of inflation. So that's the cost. The cost to manufacture goods. It's like wholesale pricing compared to
Sure.
consumer pricing, and that came in slightly above expectations today, which just triggered another quarter point loss in the market. So it's been, but at the same time, you can look at these things and be like, okay, look, we're pretty far away from like a 200-day moving average on
Yeah.
rates. And so as a loan officer and somebody that's dialed into that, I'm saying like, if I'm getting a purchase agreement today, I'm not locking that loan today. Like just looking at like some of the like how things are overbought and oversold. Like I'm probably going to wait until the middle of next week and see what happens, and
Yeah.
probably see a lot of these things come back because they just, as these bonds start to go up in the yields, right? And so now you're making 4.1% on a 10-year treasury. Well, all of a sudden you get a slew of buyers. That's a pretty good investment, right? So you get a slew of buyers for that. And as that demand picks up, then you can decrease the yield slowly. And we start to see rates move back to that center line that they're at, or that 200-day moving average. So, it's just a volatile time. And as if I'm a home buyer, if I'm a buyer's agent right now, or even a listing agent, and it might even be a new thing for a listing agent, like, hey, how close is your buyer on locking loans? I mean, you got a loan at 46% on a Fannie Mae loan, or 45.9. If that loan goes to 46.4, you might be approved ineligible or refer eligible
Hmm.
now. Now your debt to income ratio is out of whack. Like those loans can be that finicky in a debt to income ratio thing. So locking a rate, like when I get a contract, if I'm real tight on that and I work today, I'm locking that loan today. And that's a question. That's something I'm definitely telling all my buyers out there is like, hey, as soon as you get a contract accepted, get me on the phone and let's talk rates. Don't wait
Yeah.
till after your inspection. Don't wait on those things.
Well, that's just a testament of like what you just did to me, where my head was going was like realtors. Hopefully, you work with a great loan officer like Steve,
Yeah,
because it's a lot more than your loan officer takes you golfing once a month. There's a lot more
right.
to it. So, when you just kind of look ahead short term, just maybe in the next week between now and our next episode, are there anything that you're looking forward to seeing, to hearing, that will be released economic data wise, that you think that could have an impact? Or what is it that we can look forward to in the short term?
So as far as like, really market moving economic data, we don't have anything really coming in the next week. So again, we're playing with the market, and that's going back to what I said about looking at some of these moving averages and things like that. There's nothing that's going to drive these rates. So now we look back at technical data and say, okay, what has happened every time this has happened? So we can, because economic reports do the same thing every week, like, or
Sure.
every month they go through the CPI comes out the ninth or 10th or around there of every month. The employment report comes out the first Friday of every month. So the date tracking for all this economic information. So there's not going to be anything that's going to go crazy in the markets. There'll be some like consumer confidence numbers, small business confidence numbers. We'll start to get more housing data next week, which is always interesting. It doesn't necessarily move rates around that much, but it's always interesting to see what appreciation and things like that are doing.
Yeah. So I guess, I'm curious, like, how are these conversations going? You talk a lot about like the real world of people buying and selling houses is what we deal with every single day. What, how are these conversations going with people that you're talking to that are getting mortgages right now at 7.25? Are they more accepting of that, or are they more still sticker shock, or how do those conversations typically go?
The sticker shock's gone. I mean, it's been in the news cycle enough
Yeah.
now that mortgage rates are at all-time highs. And so it really, I try to, you tell them like, look, your interest rate's going to be 7%, and you
Yeah.
just get it out there and say, but the good news is, you were looking at a monthly payment of
Right.
this in the beginning, and this is what your monthly payment is based on taxes and insurance. This is what your cash to close is. So that's the brass tacks of it. Like, you don't write your interest rate on your check every month. And based on our initial conversation, this still falls in line with your budget, even though it's not exactly what we want. We can look at a refinance for you down the road if rates do drop. But again, let's take a look at this monthly payment. Does this work for you and your family? Yeah, it does. Here's our cash to close number. Is this number still okay with you and fit your budget? Yes, it does. Okay, great. This is what we're going to do. And then we just go into proceeding with the next steps in the process, because you and I both know that I mean the interest rate that you get is just so out of our control with timing. The best thing you can do is focus on that payment and focus on that cash to close number. If we come into a situation where the payment's higher than they want, that it's you just break it down. Like,
Yeah.
it's math is the nice part about mortgages is the math does the talking. So
Right.
you say, okay, there's two things we can do. We can borrow less money, or we can decrease our interest rate and bring in more money by paying it down a little bit. Which one of those things do you want to look toward, and what is your propensity for cash to closing, and what is your propensity for whatever different school district or however you have to alter your budget?
Yeah. So here's my question for you, because I think the big hang up, like, I literally put a post in one of the groups, one of the groups of agents that I coach last week. Like, hey, what's the number one objection you're getting? And I'll come back to that, but I'm curious to get your answer first, and then I'll relinquish this to the audience. Like, mostly you're dealing with people that are looking to purchase a property, right? Refinances, we're not talking about that right now. We're talking about people that have to buy a house. How often, there's no right or wrong answer. I'm just curious, how often are you talking to someone who has to buy a house who says, well, um, I'll wait. I'm just going to wait to buy this house until interest rates come down, versus just accepting what rates are, and given the fact that we can't do anything to control it, that they're buying anyways.
I mean, I get a little bit of it. I'm not getting a
Yeah.
lot. And so I always remember, actually, I learned this from you in one of your events, is that, I forget the exact wording of it, but people, they're most likely to believe what they believe, or believe in what they feel, or whatever,
Yeah.
however they see it. And so I don't try to change anybody's mind. Right. But you have to you just you ask them questions like, well, what's the point of the move? And if
Yep.
somebody is moving because they've got a growing family, then you say, look, here's what this house is worth today. And there's some calculators that we have and some things we can use, like the cost of waiting and looking at projections of home values. And then you can compare the interest rates today versus a rate that's a point lower, but at a property that's maybe increased 7 or 8% in value, and you're starting at 400,000, and saying like, look, here's what some of these variables are, and here's what you can potentially get for your house today. It's you. Why don't you take the data? Like, that's all I can do is provide you the data and make the
Right.
decision on your own. Most times they come around and say, okay, like, once they get a taste of the numbers and you let it kind of sit with them and you make that explanation, and then we have a pretty chart that we send out. And once they get that information from them, they either, most cases are like, hey, we're more open to this. Let's go ahead and issue the pre-approval letter, get that to our agent, and start seeing what's in the market. Now, some of those will sit for 6 months, and some of those
Right.
people will turn around and have a contract to you in the next couple of days. So it's really kind of a toss up.
The reason I ask you, Steve, is because, like, I think a lot of real estate agents are like hung up around this thing that we can't control, which is interest rates. So they're like, well, how do you deal with all these people who say they're not going to move and they're not going to sell until interest rates come down? I say, you're dealing with the wrong people. Like, you're focusing
Yeah.
on a segment of the marketplace, because here's the thing: 4.5 million people are going to move regardless of interest
Yeah.
rates. So I'm like, stop being hung up around this thing that you cannot control, and like, Because my thought is like people that are going to move regardless of interest rates. If you're dealing with a prospect who is literally trying to time the market and only going to move based on what a mortgage rate is, I don't know if that's the best use of your time. Like there's so many people out there in the marketplace that are going to buy or sell a house regardless of mortgage rates. That's where we need to focus our time. You focusing on all your energy on trying to come up with an objection handler on how to overcome I'm not moving until rates come down, probably not a great use of your time. How do you see that?
You're never going to change that person's mind,
No.
right? They have to believe that on their own. And again, if my advice to that agent would be, if get with a lender if you have one, or if you know how to do the research on your own, provide them that data. Like this is the cost of waiting, and this is what your new payment would be, and just give them the info and say, make the decision and move on. You're looking at like a 20-minute investment into, putting some numbers together, and then you just, that way you leave them with something and you move on. But yeah, you're right. There's no sense in, if that's there's a lot of people that the interest rate is the mountain they're going to stand on.
That's
Like
right.
that's what they're tied to. And I've learned that more than anything in the mortgage business, and
That's
all you
right.
can do is, like we've always said, focus on the goal. Like, I know you don't want to give up your mortgage rate, but you've got $80,000 in credit card debt, and those kind of
Yep.
things. Focus on, like, here's your goals. Here's what we can do. Here's what the cost of waiting is. Like, you decide. Like, I'm happy to help you when you're ready. But yeah, I for sure, I wouldn't be. I mean, you have to look at how valuable that lead is to you, for sure.
So, for people watching this, if you guys are still with us, 20 minutes in this conversation, if you would find it valuable for Steve and I to break down the cost of waiting analysis, just put that in the comment section beneath this video. Just say cost, the waiting, or the cost of waiting analysis in the comments underneath this video, and then maybe you and I, Steve, can take maybe next week's episode and do
Yeah,
that for a lot of the real estate agents and loan officers that listen to the show. And I think that could be really, really helpful for people, because I think you're right. We're not in the business of like convincing people to do anything as much as we are in the business of giving people, like, our job is to be advisors. And so it's like,
yeah,
here are your options. You get to decide for you on what you think makes the most sense. I don't get to make that decision, but my job as your real estate partner is to present you with all of your options. And so if we're
100%.
not presenting that cost of waiting analysis, then we are doing a disservice for our clients. So if you guys want that, just put that in the comments. And so, Steve, we appreciate your time like always, my friend.
All right, man. Thanks.